over the last couple of weeks, we've had some situations where the market is speaking loudly, particularly in fixed income. And I'll just reference two. The first is the announcement of the America Jobs Plan, right? $2.5 trillion package that announced by President Biden. And then secondly was the March job numbers, which at 900,000 plus new jobs was a full third higher than the consensus.
And you called it right. You talked about 1 million jobs, 2 weeks ago.
Yes, exactly. So kind of in the right direction. But what's interesting is how the bond market reacted, because I think this gives us a sense of what we might see happening with these inflation numbers. So the bond market with a $2.5 trillion rescue plan, jobs plan, after a $2 trillion rescue plan and a much bigger than expected jobs gain, what did the bond market do? It rallied, right? Interest rates fell. And so that tells me that an awful lot of the concern and the kind of offsides nature of the fixed income community has been redressed. And now it's consensus that we're going to end the year around 2% on the 10-year, somewhere between 2.5% and 3% on the 30-year. And so the element of surprise, which is when you get the sharp moves. And look, we had an 80 basis point backup in bonds, U.S. Treasuries on the 10-year in the first quarter, 30 basis point backup in March, and yet stocks were up for the quarter, up for the month. And I think that tells you market equities are fine when rates are going up because the economy is recovering. It's perfectly fine. And so I expect, again, that to continue. You now have a situation where technically they look a lot better. And so to me, it's and the credit concerns I think are overstated. I tweeted out, and folks should follow me on Twitter. I know Roberto and I go back and forth a fair bit. You're wonderful on Twitter, Roberto, and that's great. But I tweeted out that even with the guidance of the regulators in the Chinese banking system, they're still targeting 11% year-over-year loan growth. So it's not as if they're saying, oh, we have to shrink the system. They're saying we don't. It was at like 15 to 20%, I guess, here in the beginning of the year, and so they're reining that back. But look, I mean, one simple thing to keep in mind is that this is the 100th anniversary of the Chinese party, and I highly doubt that they're going to allow anything to happen to mar that celebration. And so to me, I think the Chinese concerns are overdone, and I'm spending more time looking at it as a potential area to add than to do anything else.
For the Nasdaq-led rally will be the fact that the surprise in rates, inflation has not happened. So actually, let's say we do get a 3.5% or even 4% inflation print. All of the Fed talk and and the fact that this has already, that the markets have been already prepared for this. Is that what leads to a rates rally?
Yeah, I mean, it's basically as simple as we had an 80 basis point backup in a quarter, right? Who's to say we can't have a 25 basis point rally?
Yeah.
And all of a sudden, foreign buyers come in, because you have to remember, the treasuries represent like 65 or 70% of the positive yielding government debt in the world today. So there's still not a lot of liquid yielding safe assets. And so a lot, as I mentioned, I think people have gotten on sides. You remember we talked about it at the turn of the year that the biggest single offsides call the sell side had going into 2021 was the forecast of the 10-year ending the year at 1.2%. That's now gone. Everybody's at 2% or north of 2% for the year end. So all I'm saying, kind of, Roberto, and it wasn't even me, I picked it up off a guy who is quite active, David Hunter. I gave him a hat tip in the piece. someone to follow maybe on Twitter. Interesting points of view. But he was the one, or at least that I saw, talking about a surprise counter trend rally that takes the 10-year underneath 150, and that because of the effect of higher rates on long duration growth stocks, the biggest beneficiaries would be the NASDAQ, which has now corrected fully, right? You've had a 15% pullback, so it's ripe for a move perhaps. And so I want to protect my portfolio, my model, which doesn't have much of US tech exposure. It has the thematic exposure, but not the dominant tech exposure. We're in the innovative side of tech. Remember, I wrote that piece, The Musings, down with innovation, up with innovation. So that's the idea. Counter trend surprise rally, rates drop as opposed to going higher. NASDAQ outperforms, and will that thematic slice of the portfolio, will it serve as a little bit of a hedge? Will it too go up, somewhat in line with the NASDAQ? Because if that happens, the value side is not going to go up, right? So you need something to kind of balance, and I feel like the thematic does balance a little bit the value side of the portfolio. One of the things that struck me was the absence of talk about carbon and reducing the carbon footprint when the jobs plan came out, which has a big climate component to it. But carbon was really not mentioned at all. So that was the first thing that kind of raised my antenna. The second was seeing that John Kerry, who is the climate czar for President Biden, is scheduled to be in China, I believe, this week. And so that made me think that perhaps there's a deal brewing to deal with carbon, perhaps being announced at the virtual, I guess, Earth Day Summit at the end of this month that President Biden is hosting. And so I know you're aware that Europe is very focused on what it calls its Carbon Border Adjustment Mechanism, CBAM. And the US is saying, please don't put that into effect because US companies are going to be hurt. But I think, what if there can be some sort of an arrangement between Europe, China, and the United States for a common, much as we're seeing discussion around common taxation of corporates, right? That conversation is moving ahead fast because every government needs revenue, right? Who's got the revenue? The corporates got the revenue. So who's going to pay? That's easy.